Hey all, my name is Paul Borosky and I am the owner of Quality Business Plan as well as the author of The Beginner's Guide to Understanding Financial Statements and Financial Ratios, which is published on Amazon.com as well as Amazon.com 2021 Financial Report as well as its Beginner's Guide. And in this video, what I want to do is go over Amazon's 2021 current ratios and quick ratio financial analysis. So for this video, what I've done is I've calculated the current ratio and the quick ratio for Amazon over the last 5 years, and we're just going to run through it and see what we can ascertain from my findings. All right, so let's go ahead and zip through this little handy-dandy PowerPoint presentation. So first and foremost, like I said, Amazon 2021 is what we're going to be targeting, their current ratio from 2017 to 2021. So the current ratio, as we know, is simply the current assets divided by the current liabilities. And so what that tells us is that if the current assets are greater than the current liabilities, what's going to happen is we're going to get a current ratio of 1.01 and above. If the current assets are less than the current liabilities, we're going to have a decimal number at 0.9, 0.8, 0.7, 0.5, or what have you, but it's going to be smaller than 1.0. In finance, what we like to see is a current ratio of approximately 1.0 or above, which means that the organization is balancing they have enough current assets to cover their current liabilities, which means they should be solvent, liquid for the short term. All right, so with Amazon, their current ratio for 2017 was 1.04. In the next year, the organization's current ratio would slightly increase, which means their current assets increase at a faster pace as compared to their current liabilities, which gave us a current ratio of 1.1. In 2020, it would go slightly down to 1.05, and then 2021, it would climb a little bit higher to about 1.14. So from just using the golden rule for finance, this tells us that the organization is short term. They are solvent. They are financially solvent for the short term. So they get enough money to cover the current assets as compared to their current liabilities. However, from my experience in looking at multinational organizations that have continuous cash flow, like your Home Depots, your Walmarts, your Targets and such, they tend to have a current ratio that is closer to about a 0.9 or a 0.8, which means that they are using their cash flows to cover the current liabilities. Amazon, I would put Amazon in that category of a daily cash flow generating organization, which means if the organization is truly optimizing their current assets, then their current ratio should be closer to a 0.9, 0.95, or even a 0.85. However, instead of going down, their trajectory for the last year is going up. And so that tells me that they're probably not managing their short-term assets in an optimal way. Now, to take a better look at their usage of current assets as compared to current liabilities, we take a look at the quick ratio. For the quick ratio, this formula is the current assets, which is similar to the current ratio, but we're going to back out the inventory because that takes a little bit longer to move. And once we back out the inventory, then what we're going to do is we're going to divide the difference by our current liabilities. When we do that, in 2017, the organization's quick ratio was 0.76. In the next 4 years, the organization's quick ratio would climb up to 0.91. So this tells us that the organization, less their inventory, which is, again, takes a little bit longer to move to turn into a liquid asset, they've got enough liquid assets to cover just about a little over 90% of their current liabilities. This tells us, in my most humble opinion, is the organization is holding too much cash, and also too much short-term or short-term investments. A better strategy for the organization would be to divest some of this cash or short-term investments, whether it's to invest those funds into long-term projects such as property, plant, and equipment, do some acquisitions, or even kick out some money to your investors through dividend payments. But the company, again, this just solidifies the thought that the organization is not fully or optimally managing their short-term. They're not optimally managing their current assets. So again, a better strategy or a better outcome for a quick ratio, I'd like to see it at a 0.6 or a 0.55. I'd definitely bring it a little bit lower. Cash and short-term investments is not going to generate as high as a return as investing it into long-term projects. All right, so hopefully this information was helpful. And just to give you all a little bit of background about myself, I am, again, Paul Borosky, owner of the Quality Business Plan and a published author for financial modeling books. I am a financial business plan writer and also a financial modeler. If y'all do want one of my company reports, you can find it at qualitybusinessplan.com/public company financial reports. I have financial reports as well as beginner's guides for various public companies such as Amazon, Apple, Disney, and so on. You can get some of those reports on my website. Also, again, I am the author of The Beginner's Guide to Understanding Financial Statements and Financial Ratios. It's published on Amazon. Definitely check me out there. And then finally, I am an adjunct professor and subject matter expert for business and finance. So I do have a little bit of education backing up my thoughts and ideas. All right, so hopefully this video was helpful. If you'd like to give me a thumbs up on YouTube, and as always, have a great day.